the assessee, the assessment year, the previous year. So various other important element of tax we have seen. In today's class, in today's lecture, apart from that banking types of banks, I wanted to tell you about the capital and revenue expenditures and receipts. Right? Capital expenditures we'll see today, and the receipts we'll see in the other class. So the capital and revenue items are very important while assessing the income. All right, you have to analyze the capital and revenue items to determine which items appears in which financial statement. Suppose if there are revenue items are those which will recur again and again, right? Which will recur again and again, and the duration of the revenue item will be very less. So this, because of this, these are not recorded in balance sheet. This will be recorded in your profit and loss account. Similarly, capital items are those which will not be recorded in your P&L because this will have a long-term effect. Hence, this will be recorded in the balance sheet. So, before this, you have to recognize the profit. Profit means your revenue receipts minus revenue expenses. So, whatever you are selling, sale of the goods, sale of services, that is called as revenue receipts minus minus the revenue expenses. The expenses like salary and all other revenue expenses, if you deduct in that, you will get profit. So to determine the tax, it is very important that you have to analyze which are revenue receipts and which are capital receipts. Right? That is what we are going to do in today's lecture. Okay, as I have told you, capital receipts comprises of contribution of capital into the business by the proprietor, partner, or shareholders. It is nothing but the investment of capital in the business. Those are the capital receipts. If you invest a capital in a business, that investment will be huge, and you will be using it not only for paying the salary, you will be using it for the payment of, for the thing of various things like construction, right, expansion, or various other facilities like buying of some heavy machines, etc. So there you are using that particular amount of capital. Similarly, any sum received from debenture holders. If you receive any sum from a debenture holders, it is not a revenue receipt. Remember, it is a capital receipt. And any loans you are receiving it. If you are receiving any loans, right? Any loans you have got, generally loans, duration of the loan, if it is more long-term loan or a medium-term loan, so we call that as a capital receipts. Sale proceeds of fixed assets, long-term investments are all the capital receipts. If you sell your fixed assets like land, if you sell your fixed assets like machine or any other fixed assets, and you get some sale proceeds, means you get some amount by selling it. So that amount what you have got, it is not the revenue receipts, it is capital receipts. You have to differentiate this. Similarly, revenue receipts or income means what? It is these are the outcomes of the firm's activities in the accounting period. These are the outcomes, which means the sale, the particularly the thing what is coming out of your business, that is revenue receipts. Then money received on sale of the goods in trade or rendering the services. If you get any money by selling the goods, remember, if you sell the assets and get the income, that is capital receipts. If you sell the goods and get any income, that is called as revenue receipts. So like examples of revenue receipts is sales, commission, fees received, interest, dividend on investment. These all are the types of revenue receipts. Okay, now there is certain distinction. Based on the meaning and definition, we can analyze the distinction. First is, in capital receipts, includes amounts realized by the sale of fixed assets or by issue of shares or debentures. Right? This all includes the sale of fixed assets or by issue of shares or debentures. And then includes amounts realized by sale of goods or rendering services. Right? So this is the first difference. Second is, it is the receipts in substitution of a source of income. So this is not the actual source of income. There is a difference between source of income and substitution to a source of income. If you sell the goods, you get an income by that, that is source of income. If you sell your assets and get the income, that is called as substitution to the source of income. So capital receipt is substitution to the source of income. Then revenue receipt, it is receipt in the substitution of an income. Right? If you get a revenue receipt, it is nothing but a income, right, on your income, or it is a sale on your income. Amount received for surrender of certain rights under an agreement is a capital receipts, because a capital receipt is being given up in form of these rights. Amount received in compensation under the agreement for the loss of future receipts is a revenue receipts. Right? If you get any loss on the future outstanding receipts, those are revenue receipts. And if you surrender your rights of the future, if you give up your rights of the future, so those are called as capital receipts. Now, if you classify this on the basis of that, the capital income or capital receipts, revenue income is classified into two types: capital income or capital receipts. Revenue income or revenue receipts, both are one and the same. Why we have to analyze in tax? See, you analyze this when you go for, there is one chapter in income tax, we call that as income from business and profession. In income from business and profession, there some of the accountant, if they have done a mistake, right, by mistake they have taken the capital receipts or capital expenditures in P&L account, and the revenue expenditure or receipt they have taken in balance sheet. So you have to rectify those errors, and then you have to correctly you have to prepare the net profit or the gross total income of that particular businessman. So the classification of income is very important. The income is classified into two types. First is capital income and second is revenue income. Okay, capital profit, capital income or capital are one and the same. Capital profits are the profit earned on the accounts of sales of fixed assets or in connection with the share capital. As I have told you, if you sell your assets, if you sell your connection with the share capital, the capital income you will get. So that profit is called as capital profit. Similarly, for example, you can see here, if you get any share premium, right? Share premium as we know, it is an extra amount. As we see that shares, it can be issued on the three bases. First is par, second is premium, and third is discount. If you are going to issue at the same price, face value is also same and issuing at the same price, it is called as issued at par. If the face value is less, if you are issuing at more price, it is called as premium. Premium will be generally more than the face value of the share, right? Similarly, discount is the third type. Face value of the share is more and you are receiving even less than that, the face value. Suppose 100 is the face value, issuing it at 90 rupees. So this is discount. So if you are issuing a share at a premium, so extra amount of premium what you are getting, right, it is called as a capital receipt. That is one example. Similarly, you are selling the assets, sale of fixed assets for a value more than that of which it is purchased. You purchase a land for your business in 2010 for 10 lakh rupees. Currently, the price of the land is not 10 lakh rupees. The price of the land is 50 lakh rupees. So additional, how much you are getting? You are getting 40 lakh rupees additional. 10 lakh rupees is the book value. 50 lakh rupees is the market value. So you are getting 50 lakh rupees totally, but you have to remove 10 lakh as a book value. So the total profit you are getting is how much? 40 lakhs. So that 40 lakhs of profit is the capital income. It is not revenue income. So we are not going to record this in our particular books of accounts. It is separate amount of tax we are going to pay on this. Now revenue profit. So revenue income or a profit are those earned in the ordinary course of a business. Normal course of a business, ordinary course of a business, you are getting a profit. That is revenue profit. It is an income which is arising out of and in the regular course of a business, right? So you are going to record this in P&L account. Remember, if you get any revenue, if you are getting a direct revenue, direct profit, gross profit recorded in the trading account. Indirect profit you will get in P&L account. But revenue income is recorded either in trading account or P&L account. But it is not taken directly in balance sheet. Whatever net profit is there, that net profit will be highlighted in balance sheet. But directly you are not going to take that particular sales in the balance sheet. Okay, any doubts in this? So we have seen today about two things.